Disneyland, they lock you in, now you gotta go on a ride. That's where we're at. So appreciate you guys joining us today. So I'm going to try to be making this like an annual ritual, coming out and visiting you guys so you can always kind of pit stop, kind of check in with you. Today we're going to be talking, as you know, all of you guys are participants in our 401k plan. And then we've also, the company's been nice enough to offer also a profit sharing plan too. So you got to have those two pieces working for you. We'll be talking about that, how that fits into your overall investment portfolio. Today we have Grant Lee from Morgan Stanley and Bill Breck, who just stepped out. Both of them are coming to us from Morgan Stanley. They work as the investment advisors. They work as our investment advisors from Morgan Stanley and help us with both the 401k plan and the profit sharing plans. Yeah, we're going to be working kind of these sports on your early screens.
I just bumped your tripod on the camera. Oh, you're fine.
So like I said, we're going to be talking today about the 401k plan. Sometimes you may hear us internally refer to it as the K plan. But we'll be talking about that. And then if you have any questions, we can answer things about the profit sharing plan too. So just kind of cover some bases. Right now with the 401k plan, the company provides a match of 33% on your first $3,000 of contributions that you make. And so I've got that up in the board right there. So I just want to remind you about that. You know, so if you do $3,000, the maximum that you can contribute and get a match, you'll get $1,000 automatically by the company that we fund every month until you hit that maximum. And then secondly, just to cover some basics here as it relates to the 401k plan, you can contribute up to a maximum of $18,500 if you're under the age of 50. And for example, this year if you're turning 50 or older, you can contribute up to $24,500. Okay. And then just to give you, remind you, so we're going to be talking a lot about 401k plan because that is the part that you guys make fund choices and you get to direct the investments on that. On the profit sharing plan, Grant's team and Bill, they both work with Grant and Bill from Morgan Stanley, work with our two trustees in terms of making investment choices for the profit sharing plan. Okay, so I'm going to turn it over to Bill and Grant, kind of get you going on this. One thing, you know, this we're here for you guys. Okay, and some of this stuff can be a little bit tricky and get a little bit technical. So if anything is starting to get gray and fuzzy, you know, maybe if you want, you don't have to ask a question or can you repeat that. Just raise your hand and that'll help get signal to us that you were getting kind of a little bit further into this and we're going to have some troubles. You know, connecting the dots because there's just a lot of data here to go through. Okay, great, thanks.
Bottom line, this isn't a presentation. This is meant to be interactive. Just jump in when you have a question, you don't understand something. Just jump in, and we'll try to explain. So Bill and I have been working with Walter's Book since 1986. Made some jokes earlier. I had hair then, I was good looking then. Bill's still the same, he hasn't aged one bit.
I'm getting gray and he's the size
He's got curly hair. He's looked really good. But our phone numbers are here. There is this deck here that we're going to leave behind too.
And this will be sent out by Deanna to everybody.
And
okay, so don't worry about taking lots of notes.
If you didn't take any notes, I don't remember anything we talked about today. This intro to investing is a really good piece. It's really basic, it's really short, but it kind of gets you home to most of what you should understand and what you need to do. And it's really, really simple. Today, we're going to start off by focusing on something else. What we really are here to talk about today is you come to work, you work hard, you get a paycheck. Part of that paycheck goes out to Sam, part of that paycheck you're putting away. And you're putting it away in this 401k plan. In addition to that, the company puts away a little bit of money for you in that profit sharing plan as well. You have to be here for a certain amount of years to vest it or earn it, and then they keep contributing to it seems like every year. So now, then they deduct it from your paycheck, it's before taxes, and then you get your paycheck. You get your after-tax savings. So when we talk about savings and investment, it's the part that you don't consume of your paycheck, you can save, right? Okay? And this part that you're putting in before taxes, you can save as well, and you are saving. And we're going to help you direct that. But when you think about how you're going to get from point A, where you're at now, to point B, 10 years from now, 20 years from now, you got to take everything into consideration. So these concepts work across the board. Okay? So now, thinking about that savings that you're making in the K plan, and thinking about the possibility of savings, outside of that in your own after-tax paycheck, what are the two things you can do with your investable dollars? What are the two things you can do with it?
Retire.
Besides spending. You already said you're going to spend a lot of it, but what are you going to do with the investment part? What are the two things you can do? You can invest it, but in what?
Yeah. Change different company stocks.
Stocks, mutual funds, real estate. So all these investments and things you just said fall into two broad categories. So one thing you can do is you can invest something and buy it and own it. And when you buy it and own it, the asset's going to go up or down predominantly. You want it to go up. But it can go down. Did real estate go down? In 08, 09, it's kind of, yeah. Yeah, so did stocks. Stocks are pretty ugly too. So you can buy it and own it. It's going to appreciate or depreciate. It's going to provide very little income, so a very tiny amount of cash flow, maybe a dividend. But we call this equity, or stocks, or real estate, or collectibles. Anything, land, anything that you buy, you own it, you have an equity position in it, you're hoping it goes up, it can go down. And you have to ride the volatility up. It's really hard to time. So one thing you can do is you can buy it and own it. The other thing you can do is you can lend it.
Oh, really?
Lend it. What do you do when you go to the bank?
Transactions.
Besides taking money out, do you put money in?
Yeah.
What do you put the money into?
Savings account.
Savings account. CDs, time deposits, money market funds, right? You're lending the money to the bank. You have the right to demand that money right back anytime you want it. So you're not going to get much of a return because they have to act right away if you want the money. They got to give it right back to you. So you pay your bills or do whatever you want with it. But that's a form of lending, going to the bank. So what does the bank pay you?
Interest?
How much?
Not much.
Not much. Pays you interest. And right now that interest is probably less than 0.75%. That's not 75%, that's 0.75%. That's less than 1%. So that's 75 cents of interest in every $100. That's not going to help you retire very well. Who else can you lend to? You can lend to Uncle Sam in a U.S. Treasury bond.
They might not give it back though.
They might not give it back. But the rest of the world thinks the U.S. Treasury is really secure. Sometimes we're kind of skeptical. But so far, they've been pretty good in returning the money, okay? So for a 10-year loan to the bank, to the Treasury, to the U.S. government, what kind of interest rate are we earning today? 2 to 3%. So right now, that rate is at a smacking 3%. Smacking 3%. If I lend my money to Walters and Walt, a company, what should I earn on that money? Is Walters and Wolf a larger risk than the U.S. Treasury? No, some would argue that it's not, because Randy's incredible. But he's not the government, right? He couldn't just go print money and pay you back. Well, maybe he does. He might have money for you somewhere in the back after all. But can we edit that? Can we edit that? So at any rate, it should be more than this rate, though, because Walters and Wolf is a bigger risk than Treasury. So maybe it's going to be 5 to 6%. So when you lend your money, what are the two things that determine what rate you should get in interest? Risk, credit risk, and what was that? Time. So credit risk, I like this, I like it. You guys are active. Credit risk is pent-up work, and time to get out of it. And term, so time. So there's some really lousy people that you can lend it to, and you can get 8 to 15%, but that's much more risky lending, and you might not get your money back when they promise. Okay, so there's two things you can fundamentally do. You can take your investment assets, you can buy things and own them, and hopefully they'll appreciate, but they can depreciate. They come in some of these types of forms, and you can lend it. And we've seen some various rates, and the rate of return is going to be determined by how big a risk it is who you're lending money to, and how long you're lending it to. Now, what kind of rate of return do we typically expect here?
5%. Yeah.
10%.
There you go.
Good guess.
It's typically 9 to 10%. Okay, let's stop right there. Stop right there. Now, does everybody know what the rule of 72 is?
What is it,
It's a
Kevin?
plan. It's a plan.
It's 72 and they can go and the money will double.
There you go. So, rule of 72 says, if I earn 3% of this doggone treasury right here, how long is it going to take my money to double? I just divide 3 into 72, and it's going to take 24 years to double my money. So if I'm 30 years old, I feel like I'm 30. I may not look like it, but if I'm 30 years old, and I got $100,000, then at 3%, by 54, that'll be $200,000. By 54. That's a long time. It's a long, long time. So what about this stock stuff, and what about these investments that are called equity investments? And let's say I get 9% from it. So divide 9 into 72. It takes 8 years to double your money. Watson, there's a slight difference there. By the time I'm 54, this is 200,000. By the time I'm 54, this is 800,000. Why? Why? Power of compounding, and you're taking a lot more risk. This is practically risk-free because you know the government's going to give you the money back. But we don't know if we're going to go up or down and what period we're in. There's a 10-year period just recently, 2010, the stock market was flat. Didn't do anything. The only other period that happened again was 1965 to 75 as well. But most of the other times, over 10 to 20 to 30-year periods, you got this 9% return. But what if I can't stomach this type of return? What do I mean by stomach? Let's just look at, where's that other slide? Right over here. Let's look at the U.S. stock market. Anybody heard of the S&P 500 or the Dow Jones 30 Industrials? So this was the first index that ever came up. It was the 30 industrial companies that represented America. Now America is a little bit more diverse. There's 500. There's thousands of really good companies, but 500 of the best are contained in the S&P 500, and that's what we know real broadly as the market. Well, here is that market for 70 years. Okay? So the blue bars represent the actual return each and every calendar year. Above the line is positive, below the line is negative. So 70 years in history, 1 out of 4 years is negative. 3 out of 4 years is positive.
So you keep it in there 3 years, take it out. Keep it in there 3 years.
Too much market time, Bill. They didn't count as a market time.
The crystal ball costs a little bit more money.
Okay.
We have to charge more.
Yeah, crystal ball is really expensive.
As long as I get 8%.
And it's not very successful in trying to figure out. Like right now, everybody's guessing. Look, guys and gals, it's been 10 years since we've had a significant downturn in the market.
Oh, you're due.
Are we due? I know in California we haven't had a big earthquake since '89. It's gonna happen. Same thing here, it's gonna happen. When? Even geniuses like Bill can't figure that out. So it's very difficult to tell. Traditionally, right now, we'd be at the end, near the end of the cycle. This economy's been going for 10 years. We're in the longest running bull market in the history of the United States. So at some point, it's got to turn. It's just cyclical. Everything's cyclical. But we're also in the midst of a really good economy. So it doesn't seem like we're at the end of the cycle yet. But at some point, we're going to burst. Look at these green dots. These green dots represent the run-up, the biggest run-up in each year of the U.S. stock market. Those are pretty big numbers, huh? Those are pretty big numbers. Reflectively, the red dots represent the biggest downturn each year. One thing we recognize off this chart, there's volatility in our hills, right?
Okay.
It's just not give me a 9% every year. It doesn't happen. Okay? So this stuff goes up a lot, and it goes down a bit. Net return is 9% over a longer period of time. But you gotta gut out all this nonsense. And it's gonna happen each and every year. Yes, sir.
Now, is this your company's investment record, or is this the stock market?
This is the stock market. This is the S&P 500.
Okay, that's right.
This is just the stock market. This is the S&P 500. So again, I can take some of my savings asset, invest it long term here, hope for the 9%, and watch my money compound probably quicker than this 3%, right? So the Rule 72, which I want to leave here with, you to leave here with a basic understanding of it, someone says, hey, I got a great deal for you. Give you 4%. Then in your head, you can just divide 4 into 72. Geez, that's 18. It's going to take 18 years for my money to double. Is that what am I feeling it? Am I not feeling it? Someone comes to you and says, I got a deal that's it's going to be 15%.
Mm-hmm.
You say, oh, 15 into 70, that's like 5, that's like 4.5. That sounds pretty good, but what is it? Right? Because it's got to be risky. So, nevertheless, what we want you to know is that the sooner that you start putting money away, the more it can compound because there's more time. But it's also not too late if you're 40, or if you're 50, or if you're 60. The numbers just work out a little bit differently. All these are in this presentation that you're going to get, so you can kind of look at these. But to me, it's just mind-blowing. Even at age 50, when I look at 3%, and by 74 it's 200, here it's 400, here it's 800. But again, I don't think you want to be 100% here. And a lot of people are very commonly 50-50, half and half, and I'm still getting double money, right? Okay, so that's the rule of compounding. Here's the rule 72. Here's the two things fundamentally that we can do with our money. And then when we put it all together, there's this basic investment pyramid that we rank things on. The top of the pyramid being most risk, most return. Least risk, least return at the bottom. So here we have growth investments. Income investments are right in here. Cash and money markets are at the bank. It's down here. So things start falling into categories because there's various different ways that we can invest our money, even within these two broad categories. Like, let's just take this category. We said the bank's probably going to pay us 0.75. Yeah, they're least risk, least return. They're down here. The U.S. Treasury is going to pay us 3% for a 10-year. Yeah, they're probably somewhere in here. Okay? The U.S. stock market is S&P 500 is somewhere in here at 9%. What's up there? What's at the top? What can give us the most return and that requires the most risk?
Gambling?
That's what someone said last meeting. Bill's still researching that. How about starting a company? Startup.
So put Tesla.
Tesla. There you go.
Tesla's up there.
TSLS. Startup. It's boom or bust. 9 out of 10 fail. 1 out of 10 make it. But that 1 out of 10 might get you, 20% plus returns per annum. So venture capital, angel investing, starting companies up, small companies, small company stocks here probably. Emerging country stocks are probably there too. So what are emerging countries? The U.S. is really a big country. It's developed, got 300 million people. We have 25% of the world's total economic output. What countries are coming on right now? Does this look like anything you could think of? Okay. Yeah, China's coming up. They're an emerging country. Their economy is going to be the same size as our economy between 2025 and 2035. Same size. But 1.4 billion people versus 320 million people. So per person, we're way more efficient in America. But the economies are going to be the same size, so they're an emerging country. What other emerging country behind China is coming up? India. 1 billion people. My God, it's just crazy. 2.2 to 2.3 billion people just in those two countries. China itself, Bill pointed out last meeting, they're moving the equivalent of the population of the United States off the farms, my families were one of those, and into the cities to create a middle class. 300 to 400 million people, you're saying, dude, you're moving to the city, do your jobs there, show up. Man, your jobs in the city, go show up. So now their economy is growing because the middle class is earning more than they were on the farm, and they're spending money, beginning to consume. So we think, they're growing. So nevertheless, Brazil, Russia, India, China, etc. are emerging countries. Okay? Then what about other countries outside the U.S.? Japan, I heard, Europe, Germany, all these big countries, they're right here too. Non-U.S. developed, we call them, countries. About the same return we expect from those as well. So when we start seeing these opportunities, I get this contribution that I put in before taxes. Then I got to figure out how to divide that up. Where does it go? It's not automatically invested. I got choices. What are my choices? These are my choices. Just pass these around. Yeah. These are my choices. And when I make those choices, besides the rule of 72, there's another rule called the rule of asset allocation. What is asset allocation? It's a fancy word for saying, where are you going to put your money? And why are we focusing on that versus the actual funds that you can invest in? Because there's some brilliant studies that show, this is part of your piece in here, under the asset allocation and diversification slides. The first slide, there's these studies that showed many, many years ago that how you decide to divvy it up actually determines 90% of your return. So how much in stocks, how much in real estate, how much in bonds, how much in cash, how much in commodities, how much in gold, how much in 67 Camaros, how much in Harleys or whatever it is that you're buying to hopefully appreciate over time. Okay? So asset allocation is very important. And what's the basic rule of asset allocation? It's invest in lower risk investments. Oops. Your age. That's just a fundamental rule. So if I'm 50, then you should invest 50% in low risk or lower risk, and 50% with some risk. So then we decide, well, then where? In the U.S., outside the U.S., in smaller companies, real estate, and then the lower risk in treasuries, in the bank, money market funds, whatever have you. So I get my paycheck, I see the money loaded in, I had to fill out a form when I became employed that said, how do you want this split up or allocated? Most people set it and forget it. When they retire at age 65 to take a look at it, gee, did I have enough? Maybe not, because 100% of it was in the money market. So you got to take a look at how you set it, and don't forget it. If you don't want to make the determination of how to allocate it, on the bottom of those sheets, do you see this target date return? Retirement fund? So, young lady in the middle, what year do you plan on retiring? I'm just thinking that.
Tomorrow.
Tomorrow. Me too. Where are we going?
About 20 years.
20 years. Okay, so 20 years from now would be 2038. So maybe you do the target fund 35 or the target fund 40, 2040. And what happens there is the firm that your firm has hired, American funds, will allocate that for you, knowing that you're probably going to retire or use those funds to use for retirement purposes. So I just put up the target date 2060 up here to show you what the allocation is. This is the longest one they have out there. It's literally 42 years from now. So it's going to be the most aggressive. So this is where they start. It's 85% in stocks. It's 15% in bonds. And the way they invest this thing is 22% in direct non-U.S. stock, another 63% in mostly U.S. stock, but some of these has some international stocks in them as well. And then they do what are called these balanced portfolios. I don't know why. That's interesting. Because these themselves invest in stocks and bonds, just to confuse it more. But these have a mix of both this and this in there. And then they do 5% directly in U.S. government securities. Bottom line, they're setting the asset allocation for you. And through the course of time, as we get to 2025, 2035, 2045, 2055, they're changing these. They're modifying them because you're getting closer to retirement. As they get closer to retirement, are they going to get more risky or less risky? More? Less. Less. Why is this rule of thumb invest lower risk with your age? Say I'm 60. What that says is I should have 60% in lower risk and only 40% at risk. Why is that? And if you're 20, it would say invest 80% in higher risk and 20% in lower risk. Why is that?
That's time.
You have time. The more time you have, the more risk you can take because you can recover from it. What do you mean? Recover from what? Recover from what? Again, look at this chart. In 2008, the market was down 40%. You had $100,000 in the U.S. market in the S&P 500. It went down to $60,000 by March 24th of 2009. So the S&P 500 in 2007 was at 1,300. It went down to 666 on 3/23/09. Where is it today?
Over 18, huh?
18? Anybody else care to guess? It's at 29.30.
Wow.
Has it been 10 years? It's been a tough 10 years. But the market in the U.S. is very resilient and has come back. That's why we don't market time. That's why I try not. A lot of people would have tried just get out. I can't take this. Look at this volatility here. It's crazy. I can't take it. Take me somewhere else. Put me in cash for a while. But then you would have missed the run back up of 2,300 points. That's all these green dots that we're talking about. It's all these up years right in here. You would have missed a bit of that. When you miss a little bit of that, your returns get compressed dramatically. You lose a bit of return. So market timing is very difficult. Staying in it for the long haul is probably the way to go. But absolutely, the longer the time, the longer you have to recover from those types of drops. Right? A simple solution, or an easier solution, is to use these target date retirement funds that are already preset. And then get a chance to finish this one out. But the 2030 fund, for instance, it's 30 years ahead. I was surprised. It's still 67% in stocks. So these are people that are going to retire in 12 years. So I'm surprised that they're actually that much in stocks. I bet you, by 2020, they're going to ratchet this down to like 50, 55. And then from there, they may just bottom it out at like 40 or 50% of stocks. Because you still need that. Why do you need that ingredient in the portfolio? If we're 20 years old now, how long are we going to live? Depends on how much you drink, smoke, or do whatever. But yeah, what's the average life expectancy? 85. It's between 85 and 86 years old now. When Bill and I started the business, the life expectancy was late 70s. So we've already gained like 7 years. Just in the 30 years we've been in business, 40 years we've been in business. So they got to make the money last. So, but market difference in the target date funds, but they will adjust. Okay. Any questions so far? So 2 important things. Rule of 72, how fast does my money compound? Rule of asset allocation, this is how I got to divide things up. How I divide these things up is going to determine maybe how fast or slow I compound. And I can calculate that based on, what I think I'm going to earn. And if I got to earn more because I don't have enough, then I got to have more stocks and more, risk and less low risk stuff.
Are the fees on the target date funds more because they're putting more of their time in?
Yeah, great question. All of these are their own funds, right? So the fund group is American Fund out of LA. They're top 2 to 3 fund groups in the country. You've had this as long as we've been involved, since '96. And you probably will have it for a foreseeable road down the future because they're really solid investments. They run in gangs. So these funds, Europe Pacific is a $170 billion fund. So its fees are below half, I think it's below half of 1% now. It's somewhere around there. Most international funds run at 1 to 1.25%, but they're about half the fee. And they're actively managing it with 8 to 12 people. So if somebody leaves, because they made enough money to retire, then the other 7 to 11 people take up that position until they find another person to pick up that 1/7, 1/8, or 1/12 spot. So there's lots of continuity in how they manage the money, and it's paid off well for them. But most of these, this is probably the most expensive one. It's probably 0.8. But most of them, they're less than 1%, which used to be the old stock rule. But to manage stocks, the cost is about 1%.
But the target date funds don't cost anymore.
Yes.
Yeah.
It's a mix of whatever they allocate it to. So all these funds make up the target date, and they all have their own fees. And then on the disclosure of the target date, they can show you the blended fee. But it's still probably 0.7, I would say, somewhere around there.
And the fee's not taken until you sell, like you retire.
No,
Or is
fees,
that every year you're taking the fee out?
absolutely. Fees are taken out monthly.
Well,
Yes, so everybody's in this big pool. You own shares of this big investment company, and the fees are just taken out of the assets of the fund every month.
So when we talk about 0.7, what does that translate into, like for a $10,000 investment or a $1,000 that I have sitting in my 401k
For every $1,000, that's $7
on an annual basis.
on an annual basis.
So that's giving you the management team to, manage your money.
Yeah, that gives you the whole platform, the online platform, that gives you the management team that manages the money, and that gives you Bill and I as well to help you.
But when we look at our funds, it's already taken out of that.
You got it.
So what we add there is what we, nothing else is gonna be taken out of it.
Correct. So now look at your list. When you look at the list, we can help you place where these funds actually are. So ANCAP is more like here. Growth fund is here in terms of risk reward. Again, higher, more risk, lower, less risk. Small cap world is definitely up here. So small cap world. The Columbia mid cap index is right in here. Mid cap. The small cap index is also up here. So higher risk, higher return. So that's about as high a risk as you're going to get. Again, what they're expecting in these portfolios is a little bit more than the 9% that's expected here. Expected is 10 to 12, but sometimes they do it, sometimes they don't, right? This is 9% in here. When we look at Washington Mutual and fundamental investors, it's more down here in the risk spectrum. Some of these growth and income funds, Capital World Growth and Income. That's probably right in here. That's also right here. Capital World Growth and Income. Bond Fund of America is right here. Intermediate Bond Fund is slightly below it because all it has is a shorter term. They go invest in the same credits, but shorter term. So a little bit less risk. The money market fund obviously is here. Now, there's 5 new funds that Walters and Walt is adding. Those funds will be available November 15th on your platform. And those funds are the index funds, which I mentioned here. So these 2 funds by Columbia. And then they're also adding an iShares S&P 500 index fund. And to speak of fees, does anybody know what index funds are all about? Okay, so this index, the S&P 500 that we talked about, that represents the U.S. stock market over there, instead of having a manager try to pick the stocks within that universe, the S&P 500 index just replicates those 500 companies. So it is the index. So you don't have to guess. You're going to get a very similar return to this. Okay, and people do that. That's called passive investing. So you don't have to guess which stocks are going to be better or worse. Just buy the whole basket. And when you buy the whole basket, it's kind of a no-brainer. So you're not paying people to manage it. So it's less expensive. So the fees are lower in these index funds. Okay, and these 3 are the primary ads, and then there's another iShares bond index fund down here. And that's a lower fee for bonds too as well. If you're going to invest in bond fund, you might want to just invest in the bond index because it's cheaper. It's going to have a very similar result. The intermediate bond fund will give you a bit less risk with bonds. Anybody know what happened this week besides all the stuff with the Supreme Court? Financially, was there any news this week?
Tesla.
Pardon?
Tesla.
Tesla, that was ugly. What else? Everybody know what happened with Tesla?
No.
Bill, you want to talk about it?
You go.
Elon Musk was charged with fraud by the SEC. And the company's about to be charged with fraud as well. And the fraud is because of certain things he tweeted, and I don't know where that's going to go, but the stock is down 13%. So again, stocks, you buy Tesla because you think they're going to do great. Stock's done pretty well since it's come out. but it can go down pretty violently too. It was down 13% yesterday. 13%. Pardon me?
Blow your money.
Yeah. Yeah.
The other thing was on interest rates.
Interest rates, that's what I'm looking for. What's going on with interest rates?
Well,
Went up. How much did they move them up? 0.25%. Where are we now? So short-term Fed funds rate, which is the rate that the Fed controls, the target rate for this now is 2 to 2.25%. So that's what they're trying to get that rate to. Through the 2008 period, because you had to create cheap and free money for everybody to be rebuilding in this country, to rebuild the economy from the Great Recession, we went to 0% interest rates. Since then, the last 2 years, we brought the rates back up to 2 to 2.25, and where they're probably going to move them is to somewhere between 3 to 3.5. This is going to happen over the next 12 to 18 months. So interest rates are still moving up over the next year, probably. By the way, when interest rates move up, bond values move down. When interest rates move down, bond values move up. So bonds are negative this year. They're negative 1 to 1.5 to 2%. So even your low risk investments can have negative years as well. Usually a little bit more interspersed, 1 out of every 5 to 6 years, they're negative, as the Fed has to change around the interest rate policy for the country. So right now, if we were to look at an allocation that maybe we would put in place, given the fact that interest rates are still pretty low, and even this rate on the 10-year Treasury, most of my life the 10-year Treasury has been between 4 to 7%. It's only at 3. Most of my life, this Fed funds rate that's at 2 has been between 3 to 5%. So let's look at a 60-40 allocation. So I got my savings, and I want to invest at 60% at risk and 40% lower risk. Right now, I take 60% of this, or 36%, and put it in U.S. stocks. I take 40% of that, so 24%, and I put it in non-U.S. stocks. We talked a little bit about my brothers and sisters in China, but let's ask you this trivial question. You drink a beer, run your Harley, or sitting and, working out with people and just shooting, okay? The U.S. stock market composes how much of the world's stock market?
25%.
How much?
25%.
25? It's 25% of the world's economy. But how much of the world's stock market? I mean, stock market, so we got a great economy, we built great companies, they're managed really well. Your 25% of the world's economy, shouldn't you be 25% of the world's stock market? Kind of makes sense. But we're 53% of the world's stock market because our companies are so well managed, because we innovate so well, because you all work so hard. China, anybody care to guess what value they are of the world's stock market?
40, 47.
4. And I said by 2025 to 2035, our economies are going to be the same size. This number is going to go up over time. And I'm only bringing this out because it's going to affect all of us during our lifetimes. So we can benefit from this. But to benefit from it, you have to invest in non-U.S. stocks, right? So we can't have everything focused on U.S. stocks. I think this is probably going to go up to 15 eventually. This average is usually 45. And because the U.S. has been doing so well the last 5 years, 6 years versus everybody else, this number is 53. And this is huge. To be 53% of the world's stock market value, yeah, it's all in Jeff Bezos' pocket. Right? But it is what it is. We've done really well with regard to that. So continuing this story then, non-U.S. stocks, I would use Euro-Pacific and New World. And I would use it, and I do use it, because I own it in my own accounts. But this would be, let's see, 24, 18%? this would be 6%. And then on the US stocks, real simple, I use Mgmt. Again, I own that too as well. Growth Fund, and let's see, Washington Mutual, our fundamental investors, and then there's small cap world, which kind of swivels between both. But that's right here, I'd probably use the mid cap index and the small cap index as well. And I want these two to be about 20% of this total, so these would be about 8%. So I'd probably do something like 5 and 3 here. And here, that leaves me 28% left. I'd probably do something like 15 here and 13 here.
So Grant, because he likes to do a lot of work and take up a lot of his day, you can buy all these funds on your own, or you can just check the box on the trade date and you're done in 3 seconds. So it's that strategy is about 90% something like that. So that's, but some people like to kind of do it on their own. It's more interesting to them. That's why we encourage the target date, because you're going to end up with a very similar strategy.
And that's how I finish out the income side. So if I were to allocate a 60-40 right now using what you have available, that's how I would do it. So just to recap, we covered what you can do with your investment asset. You can lend it, or you can buy it and own it. Buying and owning it is going to get us hopefully a better return, but we got to cut out all the volatility. Lending it is going to get us markedly lower return, but it's much safer, not a lot of volatility. The rule of asset allocation says that we should invest in lower risk about our age. And the reasons for that is because the younger you are, the longer the time period that you have to recover and ride out all the bumps and cycles. The older you are, the less time you have to ride out those cycles. So maybe you want to reduce your risk. Rule of 72 gives you a good idea based on your asset allocation and then your expected return, how often that money may double for you or may grow for you, how quickly or how slowly it may grow for you. So these are just some of the fundamental basic things that you should think about when you're thinking about how do I get to point B. We call that retirement planning. And remember, the key components of retirement planning are just not paying attention to your assets. What is the other key thing you got to pay attention to? Not the markets. You got to know how much you have. You got to know how much you spend. How many of you here know what you spend every year? 2 people. But that's classic. This is America's problem. America's problem is that we don't keep track of what we spend. And to know how or if you can retire, you got to get a really decent grip on how much you spend so you can see if what you're saving is enough. Plus Social Security and any other buckets that you may have coming towards you. So that's called retirement planning. How do I get from here to here? What do I got working for me? And how much do I really need based on how I live and how much money I spend? Yeah. But that's really our Achilles heel as a country. We consume, don't pay attention to what we spend. Again, the leave behind piece is a really good piece on the asset classes. So what we discussed, own it, loan it, and it's really in basic terms, mutual funds, and then the basic tenets of investing, how you should think about investing. And it's a lot of what we already talked about, and then asset allocation. And then what you should think about if you really want to do that yourself. So if you learned anything today, you got a slam dunk way to do that asset allocation. How do you do that? I think I heard of it. Trade date, target date. Use those target date funds a lot. Right? Anything, if you can't figure out how to allocate it, all you gotta think about is when you're gonna retire and use these target date funds. Okay? Yeah, sure, absolutely.
So when we set this back years ago when we started and set it up wrong, would it be beneficial for us to take the money that's already in there and move it, or just future contribution?
That's a two-part question. So number one, it depends on how it's allocated now. So is it allocated more this way, towards fixed income, or is it allocated more towards this way? Is it in the middle? Because if I gotta take cash right now and put it in the market, the US stock market's at an all-time high. You probably don't wanna buy, I'm not gonna buy the US stock market at the all-time high. I'm cheap. I wanna buy things that are down. Well, what's down? So then you have to kind of, that's why I said it's more of a two-part answer to that. Oh, that's all my legalese. Or is it right there? There. So look at this. China's down 27%.
So you might need to make that a little bit bigger, Grant.
You guys can't see that? What's the matter with you? I'm getting good at this. So here's the US of 9.9 for the year. That's the S&P 500. That's that big basket of 500 stocks. It was only up 1.9 through the end of June. It was up 8% in July and August. It's crazy. But look at Europe. So here at FTSE's, London, France, slightly positive. Germany, -8. Spain, -7. Switzerland. And then you look at Asia, Japan just barely up. But Hong Kong and China down big time. Down 24, I checked this morning, the Shenzhen. There's 3 indexes to track: Shanghai, Shenzhen, and Hong Kong. Hong Kong's the old fuddy-duddy companies. This has been around forever. Shenzhen is like Pittsburgh. It's where all the manufacturing is. And Shanghai is where all the technology is. But why would you think China's down right now?
Tariffs.
Tariffs. Absolutely. We're fighting over our products and how we can distribute them in China, rather than them stealing our know-how and our intellectual property, our patents, and our products. We'd rather be building products and shipping them to China than having their companies stealing our IP or our patents and our know-how. Or when we go to China, in the past, the way that we've been able to start businesses there is we'd have to joint venture and basically hand over all our intelligence to them to manufacture the product there. So there always had to be a Chinese company involved. We don't want that. That's what we're really fighting. Mexico and Canada are different fights. Completely different fights. It's more manufacturing. How much to trade free of tariffs in the North American continent does a car need to be composed by North American parts and labor? Well, it's 40% now in the new NAFTA agreement of labor greater than $16. It's 72 or 5. 75% composed of North American supplied products. So if you meet those 2 requirements, then the product trades freely. If you don't, then they need to be subject to tax and tariff. The fight with Europe is different. But anybody see electric cars going on? Mm-hmm. Do we have a pretty good electric car company, all despite the fact that we've just been charged with fraud? 50%. How do you guys like the product? It's a pretty good product. Well, when we ship that product to Germany, what's the tariff over there? 25%. 20-25%. So a $50,000 car automatically has a $12,500 tax just to deliver it to Germany. That's not that fair. I don't think it's fair. So electric cars are really going to grow. Tesla's in a great position to grow, but all these tariffs are protecting those areas of the world from our product. When BMW, anybody here drive a BMW or Mercedes? Yes, few, maybe. But when they ship those cars over here, do we charge a tariff? We do. It's small. It's 5%. that just pays for the docks. That just pays for, the entry points and all the migration of those vehicles. But yeah, it's not fair. Bottom line, China's down 25%. We're using it as a nibble point. So if I were to reshuffle my portfolio right now, I wouldn't buy U.S. stocks quite yet. If I'm reshuffling it for long term, it might not make a difference if I got 20 to 30 to 40 years. But if I'm sensitive and I don't want to buy things at the top, I might just hold off on the U.S. until after the elections to see what happens with the midterms. Midterms are going to be very interesting. First-term presidents all lose seats in the House. There's only 2 first-term presidents haven't lost seats. Franklin Roosevelt and George W. Bush. Everybody else has lost seats in the House. The question is, will 23 seats be lost? 23 seats are lost. You'll have a Democratic House and most probably a Republican Senate, and what you get is called gridlock. Nothing happens. Gridlock. That's what we had in the last 6 years of Obama. Gridlock. But at least we had tax reform in 17 end up, which should help our economy for the next year and a half. Okay, but again, remember the cycle's really been long already. So we're 10th year of our economic cycle. We're in the longest bull market already in the history of the United States. When we're moving money around, we just got to be a little bit more careful because of that factor. If you have any questions, just dial us. We'll take a look and give you our opinion.
So you guys will actually look at our funds.
Yeah, we'll look at it. Absolutely not. Yeah. So, any questions? Any comments? Anything else you guys want to talk about?
So are we able to make adjustments and add more? Tomorrow we check them out, or we have to wait?
Jim, can they adjust their contribution level now, or is it too late?
No, you can change it at any point in time. In your case, you don't just go down to Lori. She has you complete a form, and then you can go ahead and she'll get that in to one of the upcoming payrolls. And then if you want to go in and change any of your investments or move it to a target fund, there's some, you'll go into the portals to be able to make those changes. And if you have any problems accessing your account, just immediately once you get to the login page, call the customer service folks, tell us your social security number and some of your personal information. So they'll bring you right up and stay with you on the phone to help you facilitate all your changes. So even if it takes 30, 45 minutes, that's fine. They'll stay with you the whole time. That's what's really great about American Funds. So Graham?
Where's the profit sharing investment?
Just Bill, let you guys kind of chime in on that.
Yeah, let me answer the question. You guys didn't go over this before I walked in, did you?
Oh, we did.
You did, okay.
Yeah.
Okay, so the profit sharing plan, Grant and I helped the company manage that as well. It's very similar to a target date fund, because we all know how old you are. So it's actually a little, just as a group, so it's actually going to be more conservative, but Marty Staley managed the profit sharing plan.
I was in the middle of.
Yeah, so that's right, yeah.
It's 63% in equity. It's 37% in fixed income and cash. So lower risk is 37%. Growth is 63%. We were as high as 67. We just trimmed back last quarter to 63 because the U.S. market was so high. So the investment policy target. So there's a policy statement that says the target's 60% equity. But we're just a little bit above that target. And the balance between international and U.S. is 55 U.S., 45 international, so non-U.S.
But I want to reiterate, Grant and I are, we don't cost you anything. We're part of the plan. So the Walt people have been calling us for years and years. We'll call you back if we're not at our desk. We'll call you back within 24 hours, and we can pull up your 401k account and look at it. So if you're wondering if you shift around, just call us, and we can get you covered in 15, 20 minutes. If you want to have us run like a sample retirement plan, we can do that as well. How much should I save? How much how should it be invested? We can do that all over the phone. We're happy to do it. We wish more of you call, so don't be shy. Like I said, we've been with the company for a long time. And Jim's not licensed, so everyone goes to Jim a lot of times. Hey, what should I do? So he'll usually say, hey, call Bill and Grant. Okay. And then also, if the stock market is down, or you look at your account one day and you're like, it's down, and you're tempted to push the button and say sell, call us first. Call us first. Okay. If you're all in stocks and you're going to retire next week, and it's down a lot, don't sell. Call us first. Okay. So you just got to deal with the up and down, but over time, you just got to remember what you own. You know, if you're up here, you own. If you have $500, you own $1 of Starbucks. You own $1 of Chevron. You own $1 of McDonald's. All good companies. They go down, but they come back tomorrow. Okay. But please use us. We love what we do. We love helping out. Okay.
So we have a whole team behind this, but you're not calling the 800 number, you're calling our team. So there's a good 8 to 10 of us that can help you out. That'll do the work. Yes?
We're all familiar with how we put money in, but how about when it comes time to retire, how we start pulling money out?
Yeah, great question. So when it comes time to retire, how do you pull the money out? So the 401k plan, as well as the profit sharing plan, are qualified retirement plans under the guidance of ERISA. And what this law says is that when you become 70 and a half, you must begin withdrawing from these accounts. When you are 59 and a half, you have the opportunity to begin withdrawing from these accounts. Now, if you should have to withdraw before the age of 59 and a half, then you pay a small hardship tax on top of ordinary income tax. When you pull money out of these accounts, because you haven't paid taxes on this money yet, the money that you pull out is going to be fully taxed. Okay? And the beauty about these accounts, though, it is before tax money that's growing, and all the growth during the time it's growing is not taxed. It's all deferred. So when you start pulling it out is when you pay the taxes. Okay, now how do you do that? So if you're still at the company will say, you're 70 and a half, you must begin taking money out. And there's a government table that you follow. You have to value your portfolio at the end of the year, and then you divide it by the divisor on the government table. Now, you may say, I'm going to retire at 65. I want to take the money out before. So now, in this circumstance, let's say I left the company. So when I leave the company, I can leave my money in my 401k of my previous employer. They don't really like that, but Walt has never kicked anybody out of their program. But you could also, at that point, roll it over into an IRA rollover, into an IRA account with us at Schwab, at E-Trade, TD Ameritrade, wherever you want to do it. But it must go from the qualified plan that you're in into an IRA within how many days? 60 days. Otherwise, it'll be taxed fully, 100% on the distribution. So be careful when you fill out the forms when you separate from service. You don't want any tax withheld from it.
Tax on all funds?
This is on all the funds within your 401k plan. Yes. Yes. The form will say, do you want income taxes withheld? If you're moving into an IRA, you don't want income taxes withheld. If you're just taking it all out, period, to spend, you might not have income taxes withheld because you might spend too much and not have enough to pay the income taxes of the money that you withdrew. So a lot of people roll them into IRAs, and then through the course of years, they just withdraw certain amounts that they need or are required by age 70 and a half to take out. Did that answer that? Yeah. Perfect.
Grant, most of the folks that come to you don't really have a handle on what their spend is.
Yep.
So what's kind of a general rule in terms of how much they should be saving? We know the limits. We've got the 18,500 and the 24,500.
The general rule is as much as you can.
There you go.
I would encourage you before you even, there's a rule of thumb someone brought up last meeting, but I don't know if, I've never heard that rule of thumb, to be honest with you. But one thing I might suggest you do is go to mint.com and create an account. It's free. This company is owned by Intuit, which is a publicly traded big company up in Silicon Valley. They're the owners of Quicken, and QuickBooks, and all the Quick products. This will allow you to track your spending. And all you gotta do is set it up once, and you say, pull all the transaction data from this account, my credit card, pull it from my bank account, this card. And it pulls all the data in there. You can go in and categorize it all. It takes you one time, and then when it keeps coming in, it just categorizes the same things in the same category. Repeatedly. Then by the end of the year, you kind of know where all your money went and how much you spent. Frightening, isn't it? Frightening. Yeah, I mean, frightening to look at what I spent. But I do. It's excruciating. But that's half of the problem, that we as advisors should all be urging you to figure out how much you spent. But nobody wants to talk about it. It's like the hush, the hush. It's not rocking the boat here or something. The bottom line is, this is America's problem. We don't know how much we spend. We just spend it.
Every time we get.
Every single dime.
It's the American way.
It's the American way. But at some point, we got to save and we got to put some money away so we can retire and go have some fun. Your Social Security, we don't know how long Social Security is going to last. So we can't really rely on that 100%. I'm sorry, you can say
So
something.
why not have fun now while you're young?
You should. There should be a balance, right? Should be a balance. Definitely. But it is the most ignored thing. And it is the hush thing nobody wants to talk about. We go through it with a lot of clients, and it's a battle. It's really a battle at every level. Doesn't matter how much money you have. It's a real battle to control spending. But once you know that number, it's just math. You got to figure out how much you need to support that. But if you don't know that number, who knows how long the money's going to last? And we know we're living longer. All right?
I'll share one other thing too. The great thing is that you see the pyramid of risk here. So the one thing that's great, there is one option, and this is why the company continues to encourage you to at least make that first $3,000 401k contribution, because it's the only one place where you can get a 33% return guaranteed. That you can't get under. So that's where we really
Zero
want to
risk.
encourage you.
Zero risk. Save. What else? Great. Thanks for all your time. If you have any questions in there, email us, call us. We're here. We'd like to come down once a year if they'll have us. So hopefully we'll be here back sometime next year. Thanks, everybody.
Thank you.